Joining us now, Bernstein Managing Director and Senior Analyst, Stacy Rasgon. Stacy, anything new you heard in that conversation that changes your opinion about Intel either way?
No, not really. I mean, the numbers kind of spoke for themselves last night. They screamed a pretty direct message, I think, to everybody on the street. No, there wasn't anything new that I just heard.
How much risk is there for Intel in the second half if conditions deteriorate? And by deteriorate, I mean even if the PC market doesn't get much worse, but the data center market does.
So to take those each, it's not implausible to think that the back half should be better than it better be, but it's not implausible that it could be quite a bit better. PCs right now are undergoing it's clear CPUs are undergoing a massive inventory flush in PCs. They are under shipping by a really big amount, which, by the way, you got to remember, they were over shipping by a massive amount too over the last four to 6 quarters. So that's correcting now. At some point when that flush stops and you go from under shipping demand just to shipping to it, you can get a lift. And usually PCs are stronger, just the end market in the back half versus the front half. So the idea that can get better is not crazy. It should, and it ought to. On the server side, same thing. We've got some inventory correction going on. I don't think it's nearly as bad as in PCs, but we've got some of that now. So again, you got some of that correction. I think what Pat is hoping is that the enterprise and China headwinds that they got right now start to ease. The cloud stuff, that I think that is the wild card. We'll have to see what cloud happens. Usually with cloud digestions, they last a few quarters. And they do have a product cycle. Sapphire is ramping now. You should have more Sapphire as a percentage of the mix in the back half than the front half. ASPs on Sapphire should be higher, although they're offsetting cost increases, but the ASPs should be higher. So again, revenue should be up. But I mean, look, in my model, I've got data center up, 35%, half over half. I've got PCs up a bunch, and I mean, I've got them doing about $54 billion, something like this year. Okay. It was a big revision, let's put it that way.
Right. Stacy, it's Deirdre. Something that you noted, Intel made an accounting change this quarter, extending the depreciation lifetime from 5 to 8 years. That should, of course, help with those longer-term targets. But what should investors know? Is there a risk here that the company is using this kind of accounting to get there to those longer-term targets?
Well, so they're doing it because, I mean, they are using the equipment longer. Let's be honest. I mean, historically, they were stuck on 14 nanometers for 8 years or whatever it was. And they're going to be building a foundry business where you will have more customers that are on nodes for longer. Although I would have liked them to build the foundry business before they extend the depreciation. But that's why they're doing it. They actually did it in 2016 as well. They went from 4 years to 5. This time they're going from 5 years to 8. For the listeners, the effect that has is it reduces the amount of fixed cost that they're taking every year on those same assets, and it makes the margins and the earnings look better. The Q1 guide, it was minus 15 cents. It was actually inflated by about 9 cents from this change. The Q1 gross margins were 39% is the guide. They were actually 36 without this change. And for the full year, this change inflates earnings by probably 60 cents and gross by 4 to 5 percentage points. It does not change cash flow. So that's it, but it will inflate earnings. And they have margin targets. They've said they want to get to 51 to 53. Yeah, I mean, they'll have a 4 or 5 point tailwind to try to get to that target.
So that'll help with that. More broadly, Stacy, you were on the call last night, though I know you didn't get a question. You just heard our interview. As I remarked, very, very different tone from Mr. Gelsinger. He seems humbled. He seems a lot less optimistic. Is that something that needed to happen? Is that part of the bottoming process here?
I mean, I wish it happened, when he started the job. I mean, it's sort of unusual for somebody to come into a company which is a clear turnaround and just sound that bullish right out of the gate. I mean, it was, in hindsight, not a great thing to do. They're obviously they're cutting big costs, but I mean, headcount's up 20% since he took the job. So they were hiring to a plan that they gave a plan at the analyst day. They had him doing something like $120 billion in 5 years. They were clearly hiring to that plan. They certainly didn't get a whole lot out of sounding that bullish out of the gate. So I think the tone change is warranted and helpful. I would also say, just to Pat, you're right. This was the second quarter they didn't put me on the call. People are noticing. It's not a good look. I wish that they would put me back on the call.
Stacy, a lot of our viewers probably remember a time where companies like AMD existed at the pleasure of Intel. And I wonder, when you look back, when you think that far back, Was there a moment that was truly consequential in that flip, or has it been more of a frog in water kind of dynamic?
No, they're probably so. Look, you're right. AMD at one point, I think that's a good way to put it, existed at Intel's pleasure. They AMD at that point basically got whatever scraps that Intel left on the ground. But it makes AMD's turnaround like pretty remarkable. And the controversy in AMD, 2015 or so was, are they going to go bankrupt or not? So, and it was a $2 stock, and we can argue about it now, but I mean, clearly it's not a $2 stock anymore. It's like a real business with real products, and they have leadership. I think the real issue that Intel has had, obviously, is the process technology delays. That was a biggie over time. I mean, that's sort of what gave AMD, the push that they need. And maybe you could argue AMD got lucky, but they capitalized on that delay, and AMD's roadmap has been rock solid. The current issues that Intel is having right now, they are the consequences of those longer term strategic issues and delays and everything. And then like also the nearer term, I mean, there's been execution issues just on planning to the demand environment. They clearly just massively overestimated like where things were going. So that's, I think, on the current management team. The strategic issues that they're, and the process issues, I mean, that's what Pat's trying to fix. I guess that's what he was sort of brought in to do. And if you take him at his word, they claim to have fixed the process stuff. We'll know in a few years, like if they can execute on that process roadmap or not. But I think even if they can, they're never going to be back in the position that they were in. I mean, those days are gone, because even if they can get back to parity, like, is parity enough? I mean, like, AMD's a real company now, and there are other competitors out there, and ARM is building, companies are building CPUs on ARM architecture, and there's lots of other things that are coming on. It's never going to be the kind of market that it was, 5, 6, 7 years ago for Intel.
Well, people also used to say that about Microsoft and Windows. And while it's true, they managed to build something else. You never know with these things in tech. Stacy Rasgon,
Yes, we'll see.
always good to talk to you.
You bet.
Still to come this morning, daily volume of options on Tesla nearly doubled year on year. They now account for 7% of option activity. We're going to take a look at what way those bets are leaning. And we'll get a check on intraday action here, hugging the flat line after a pretty decent week. S&P with almost a 100-point gain on the week. And, of course, compared to yesterday's nearly 11% gain. Be right back.
Welcome back to Tech Check. I'm Seema Modi. Here's your CNBC News update at this hour. The Justice Department says it has broken up an Iranian attempt to assassinate an American journalist. Attorney General Merrick Garland has announced charges against 3 members of an Eastern European crime group who are allegedly hired to silence a critic of the Iranian regime. FBI Director Wray says this case is the latest in a string of attempted threats from Iran. Scary. Shares of Goodyear Tire down 6%. The company warning fourth quarter results will be shy of estimates due largely to weak demand in Europe, the Middle East, and Africa. Goodyear also says it will lay off 500 employees, or about 5% of its workforce, as part of cost reduction efforts. And CVS and Walmart are cutting pharmacy hours at many of their stores due to staffing shortages. Starting in March, Walmart says its pharmacies will close 2 hours earlier on weekdays, and CVS says it will trim pharmacy opening times at about 2/3 of its stores. Carl, I'll send it back to you.
All right, Seema, thank you very much. Seema Modi. Let's watch Tesla today. Shares are extending the rally from yesterday, now up more than 20% for the week. Stock has seen a surge in options trading as well, according to data from Cboe Global Markets, with roughly 3 million contracts traded each day on average. That compares to 1.5 million a year ago, obviously more than any other stock. Here to discuss, KKM Financial CEO Jeff Kilberg joins us. The Journal writes about this morning. Jeff, they sort of frame it as sort of swinging for the fences in either direction. But I don't know. Others would argue, given some of the street's targets, maybe there's that much optionality in the name itself. What do you think?
Well, Carl, I think more and more investors become more sophisticated in utilizing options as a tool in their toolbox. So what's fascinating to me to see this intersection. We've never seen emotion, politics, and true technical breakdown in the stock. And look at Tesla last year, the way it came down over 80%. But January 6th, that was the capitulation day. And all the relative strength index, all the readings you saw, it was oversold. But I was selling puts at 140, at 130, and it didn't feel good, right? Carl, at the end of the day, I felt like a hood ornament. But I was being paid handsomely. I got executed, so I got put to the stock. So I've been an owner of the stock roughly around 130. I just covered about half my position here at 165. Pigs get fat, hogs get slaughtered. But it seems like the emotion, the political undercurrent that got pushed into Tesla, Elon Musk, the wake of Twitter, that really oversold the stock. And I think it has the ability technically to bounce back up to 220, kind of where it fell from last fall.
Yeah, now you're just getting to some of the base targets on the sell side. Does the volume surprise you, or does it kind of fit with the fact that he's one of the world's richest men, 100 million Twitter followers? We talk about him every day.
You know, all the family offices and hedge funds I talk to, they get attracted to volatility. They get attracted to trades like this. So, yes, we've seen a dramatic spike in option volume, but actually look at the underlying shares. A typical average volume on Tesla is about 131 million shares a day. That's nearly double right now. So I think you see the attraction. People are trying to figure out where this market is going. But at the end of the day, the volatility of vol inherently in Tesla, it's sensational. You don't see a stock opportunity like this too often. And that's what we've been seeing a lot of investors try to capitalize. Right, wrong, or indifferent, you're going to see continued volatility in this name. And that is just opportunity, Carl.
Jeff, I know you're also bullish on emerging markets. Want to pick your brain here. The EEM moving higher to start the year after challenging 2022. We're seeing near record inflows this week, with more than $1 billion flowing into emerging equity and debt markets each day of this week. Jeff, some might argue that this enormous rally means that a lot of this is already priced in. And I wonder, too, about the longer term growth story. Is that still intact? You have rising levels of debt, aging demographics, higher interest rates.
Yeah, I think you really have to take a step back and let's look on a 3-year lens. We've seen emerging markets really be quite sanguine, quite sideways. But here, as you see the dollar index coming down, and if we just rewind a little bit, Deirdre, if you remember the 10-year note, I always go back to where I cut my teeth in the fixed income U.S. Treasury pits in Chicago. But what we saw in October was that max move higher in 10-year yields. We've done nothing but come straight down since then. Now we're tethered to 3.5%. That's allowing emerging markets to heal, to move higher. That in conjunction with the Fed looking to pause as we got nice expected PCE data today, I think that puts this in a position to be poised to move higher. But remember, EEM, that ETF we like to utilize, Deirdre, to get that exposure, nearly 20% of that is China exposure. So as China is finally coming back online, that's where there's some enthusiasm. That's where there's some momentum. And I'm also an owner of PGJ. That's the Invesco Golden Dragon Index. That also gives you exposure to China. So I think you have to have a 1-2 punch here, owning EEM as well as PGJ.
Jeff, what about some of those other factors I mentioned, though, that aren't really dependent on interest rates, like aging demographics, rising rates, rising levels of debt, and fiscal strains that are emerging throughout the emerging markets?
I like to kind of look through the lens that's been priced in. I think we've become a little bit desensitized. Yes, we are obviously focused on all those factors you just mentioned, but I think if you look at that 3-year perspective, we've grappled, we've fought, we've been on the mat with all those issues. Now it seems like if we do really see this global reopening specific to China, I think this puts a lot of wind in the sails on emerging markets. But you're absolutely right. It has been a very tough trade for the last couple of years.
Jeff, great to get your insights. We'll talk to you again soon. Jeff Kilberg.
Take care.
Coming up on TechCheck, Salesforce appoints 3 new directors to the board as they prepare for a possible proxy fight with activist Elliott. That story is next.
Might be time to cash in some of those coupons. Bed Bath & Beyond rebounding a little bit after closing down 22%. The retailer did disclose that it can't settle its debts with creditors, including JP Morgan and 6th Street, and is considering filing for Chapter 11 bankruptcy. In that filing with the SEC, Bed Bath says it's trying to cut costs by lowering CapEx, closing some stores, renegotiating some leases, but that, quote, these measures may not be successful. Certainly faces an uphill battle. Shares are trading down about 80% over 12 months today, D. And as Kramer said this morning, the share donation continues for firms like, for example, a Target or a TJX.
Right. Let's also get a check on Salesforce. The stock, let's take a look. It is up by 0.6%, maybe flat, we'll call it. The company confirming plans to shake up its board of directors, adding 3 new members as it gears up for a potential proxy fight with Elliott Management. The new board members include former Carnival Cruise CEO Arnold Donald, MasterCard CFO Sachin Mehra, and Value Act Capital CEO Mazen Morfit. Elliott is, of course, not the only firm looking for change at Salesforce. The company is being targeted by a few other activist investors, including Starboard and Inclusive Capital Partners. Mark Benioff has reason to be optimistic, though perhaps the stock has soared this year as a result of investor interest, up 25%, rebounding from a rough 2022 when it fell more than 40%, sure, guys, maybe the market is optimistic that maybe it can change, but how much are they optimistic that it's Elliott and Starboard and the activist investors that are going to push, of course, the board members nominated our Benioff selections?
Yeah, but you know what catches my eye here, Carl, is Value Act on the board, because Value Act was an activist that got into Microsoft and Adobe a little bit more than a decade ago, kind of before their big cloud transitions. Those two stocks have been really doing well since then. Is this kind of like David fighting with the Philistines? For my Bible nerds out there, I mean, it's kind of like you put an activist on the board, but it's kind of like the friendly guy. I don't know. Like, is this a way of saying, yeah, we're paying attention to this stuff?
Well, it certainly fits with what Cramer said this morning, and that is that the dialogue is going to be a lot more constructive than some other activist battles we see at other companies like Disney. The other is that if the players are looking for technical expertise on the board, that certainly you could get that from someone who ran, say, Williams-Sonoma and added a lot of tech into the firm.
Yeah, no doubt. I guess the question, though, John, is Elliott going to accept that? Are they okay that they went with the other activist? We'll see.
No, come on. They want their own people on the board, right?
Yeah, I think so.
Well, up next, earnings season continues in full swing next week. We're going to get results from Meta, Alphabet, Amazon, and we've got the trades ahead of those results next.
The story this week was, of course, Microsoft and Intel, at least when you're looking at big tech. Next week, though, we will get earnings from some other big names in the space, including Meta, Alphabet, Amazon, Apple. It's going to be a busy one. So how do you position yourself ahead of those results? Our next guest named Meta his top idea for 2023 at the start of the year, and that is paying off so far with the stock up nearly 25%. Joining us now with his expectations, RBC Capital Markets, Brad Erickson. Brad, good morning to you and happy Friday. This quarter was supposed to be a clearing out event. And, Microsoft wasn't all that good if you narrow in on the Azure results, but market is taking it in stride. The NASDAQ looks to have another, winning week. How do you take all of this? Could markets be in for a surprise next week, or do you think that they've sort of the expectations are actually in line.
Yeah, so we actually just had a note out yesterday on this. We did our kind of most recent checks with ad agencies that can be sort of instructive for that forward view. And yeah, I think we came out with a view that, Q4 actually ended up okay, kind of maybe just a touch better than feared. And January, similar trends. I know you're getting mixed data points. I think American Express was out this morning, maybe sounding a little bit of the opposite. Others have sounded okay. We kind of think January is tracking pretty in line, maybe even a little bit better for the advertising guys. And so, yeah, I think we're a bit more on the optimistic side here heading into next week.
Brad, let me float an idea to you. There's advertising, which everyone assumed would be falling off a cliff. And what you're saying is maybe that's not happening. I was talking to a tech CEO earlier this week who said he's actually not cutting his advertising budget. What he is cutting is cloud spending, enterprise software spending, wherever he can to a much greater degree. Do you think it's possible that the market is looking at the wrong thing here and it could surprise on the downside like Azure did? And could that be in store for the likes of Amazon and Google?
Yeah, I do think that's entirely possible. You're right. Ad spend kind of got cut middle of last year. People got really skittish on the macro, as you recall, kind of May, June, July. And so once you cut, right, and that's maybe why we're seeing a little bit better than feared out of that part of it. But you're right. Cloud had held up, on the other hand, quite strong through Q3. Amazon on their last call, they used this word of optimization, right? They're being more proactive, helping clients maybe not quite spend so much on things they don't immediately need related to cloud services. And then Microsoft obviously had a disappointing March quarter guide earlier this week. So part of the reason, a big reason, frankly, we characterized Google and Amazon as maybe better second half ideas was because we do need to right size cloud expectations here on this upcoming earnings reports.
Meeting right smack dab in the middle of the week. And I wonder if there's a chance that the way investors react to the same kinds of earnings results we've been getting might change based on that.
And sorry, I missed the first part. Did you say Snap or Meta? I think you said Meta.
I said we've got a Fed meeting right smack dab in the middle of the week. And does that affect investor sentiment and reaction to the same kind of earnings?
Right. Unfortunately, from my seat and investors, yes. I'm no expert on the Fed. I have to follow the fundamentals of these companies, but yes, at times that becomes a much greater force in the market than the fundamental performance these companies tend to put out.
Hey, Brad, I know you probably don't cover D.C. as a policy expert, but this bubbling idea that TikTok could face much more than just guardrails has been used as a net bullish cases for Meta in the back half of the year, let's say. It looks like we might actually get some things on paper. Are you taking that seriously?
Yeah, no, I mean, I think there's clear indications that people are reserved. Certainly a lot of these public institutions, higher education, municipal governments, state governments are banning these things from their networks. And then obviously the policy initiatives you mentioned. What's interesting is that it really contrasts what we're hearing out of the advertising channel. People don't care. Everyone still, a lot of people are spending a lot of time on TikTok, and advertisers, companies, brands, products, they need to be in front of those companies, they need to be in front of that audience. And so they're continuing to spend. We actually ask these folks on our channel checks, like, hey, are you concerned about this? Sure, they are. But at this point, we're not seeing a change from their customer base. Could it affect that, obviously, and be a huge benefit for Meta or Snap, for that matter, if it were to change? Absolutely. That's not our base case, I wouldn't say at this point, though.
So, Brad, finally, who do you think is best positioned then? Of course, Amazon was able to grow their ad business, felt like overnight by the time they sort of released the numbers with that intent-driven advertising. Who are you looking for next week in terms of maybe an upside surprise?
Yeah, I think, Meta has been our call, and you mentioned, and the stock has worked. There's a little bit of concern about maybe some crowding going on there. But that said, we think there's some actually really powerful conversion trends, meaning Facebook's actually in the process of dynamically restoring that signal loss that we all talked about last year. We continue to hear evidence in the channel that they are making improvements on that front. To the degree that is playing out, that would lead to outperformance. That's how we're positioned.
Brad, great to get your insights. Have a good weekend. Brad Erickson.
Yep, good to see you.
After the break, what results from American Express and Visa tell us about the state of the consumer and a possible recession? Don't go away.
Welcome back. Earnings and some new economic data giving us some insights into the consumer today. Let's talk about Amex. Shares are surging despite a miss on the top and the bottom line. They raised the dividend by 15%. Management says we are not seeing recessionary signals. Meantime, Visa with the beat across the board. On the consumer front, they report U.S. Q1 payment volume up 9% year on year. But some of the data we got this morning may be telling a slightly different story for the short term, at least. Consumer spend for December did fall 0.2%, coupled with some underlying inflation slowing to its slowest pace since October of 21. And that all comes as investors await the Fed next week. The Fed chair, Powell, expected to hike by another 25 basis points on Wednesday. Despite those worries, stocks continue to rally here into the new year. The Nasdaq is leading us, as you know, up better than 10%, on pace for the best month since July of 22. And that doesn't even count, John, for example, one of the best years for European stocks, or at least the best start to a year in decades.
Yeah, I think we got to be careful, particularly about these companies' results and the read through to the broader economy, Dee, because a lot of these payments processors actually get a benefit from inflation because they get paid on the total dollar amount processed. And even if people are buying the same amount or maybe less, but they're paying more for it, the payments processors get paid. And then also as interest rates are higher, that can be good for some of them, depending on how their business model is structured. But if we have inflation coming down and if we have demand slowing down at the same time, that could slow down for some of these companies more rapidly than in the past.
Inflation is a tailwind for them to an extent, right? You have larger total absolute transactions. But in the long run, I think some of the CEOs have identified this. It's actually a headwind because it can lead to a pullback in spending. And that, I think, is what the market is a little nervous about going forward, as we've seen this huge boom in travel spending. Cross-border transactions look good, Carl, but if we head into a recessionary environment, inflation no longer is going to provide that bigger absolute number. People may actually pull back.
Yeah, that's exactly the bear case over at Morgan Stanley, for example, where sales decline faster than your costs can decline, and that mix is going to be dangerous, treacherous, they would argue, in the near term.
Yep. Well, still to come, the highlights from our conversation with Intel CEO Pat Gelsinger. The stock is down more than 50% since he took over in February of 2021, down another 7% today. Come off its lows, though. TechCheck is back in a moment.